Okay, check this out. On reports, record first quarter sales for 2025. That headline definitely grabbed me. And we're not just talking a small increase here. It's a massive 43% jump compared to last year. Brings them to what? CHF 726.6 million. And get this, they actually beat expectations. So yeah, let's really unpack what's happening with On.
Absolutely. I mean, growth like that, 43%, it doesn't just happen, right? There's usually some solid stuff going on underneath. So for you, we're going to really dig into On's financial report for Q1 and, also what the analysts are saying. We want to get straight to the heart of why they're doing so well and maybe what challenges are on the horizon.
Exactly. And we've got a good mix of sources, the official earnings report, obviously, plus insights from Simply Walsent, TipRanks, Stocks to Trade, SGB Media, even Hypebeast is talking about it. So our mission here in this deep dive is to pull out the really key insights behind this big quarter, understand what's driving the success, but also, keep an eye out for any potential headwinds. We want to give you the clearest, most concise picture of what really matters in all this data.
Okay, so let's start with that headline number. That's CHF 726.6 million in net sales, up 43% year over year. That's the big one that jumps out. And it's worth mentioning, even if you strip out the currency effects, looking at it on a constant currency basis, it's still a really impressive 40% growth. What's interesting is how they got there. It seems like both their direct sales and their wholesale business did really well.
Right. Diving into those channels, their direct to consumer, the DTC side, that's like when you buy straight from their website or stores, that saw a huge 45.3% increase.
Wow.
Even in constant currency, it's still 42.4%. That brought in CHF 276.9 million, and it's now, what, 38.1% of their total sales? It's a pretty big chunk.
It really is. Shows that direct connection is working for them. And then you look at their wholesale side selling through other retailers. That also had a fantastic quarter, up 41.5% or 38.6% constant currency, reaching nearly CHF 450 million there. So yeah, strong across both channels.
It really looks like they're firing on all cylinders channel-wise.
Exactly. And that strong top-line performance, it flowed down to their gross profit too. Gross profit jumped 43.5% to CHF 435.3 million. And kind of interesting, their gross profit margin. So the percentage they keep after making the goods, that actually nudged up a tiny bit from 59.7% to 59.9%. So they're holding on to their pricing power even with all that growth.
Okay, but here's where it gets a little more complex, maybe. Because while sales and gross profit look amazing, their net income, the actual bottom line profit,
Right?
that actually decreased by 38%, down to CHF 56.7 million. And the net income margin plummeted too, from 18% down to just 7.8%. That feels, well, counterintuitive, right? Sell way more, make less profit.
Yeah, that's a really crucial point. It does seem odd at first glance. But think about it this way. When a company grows that fast, like On is doing, they often have to invest a lot more money. Maybe they're spending way more on marketing to fuel that growth, or investing heavily in their supply chain, R&D, opening new stores. All those things cost money up front and can hit the net income figure in the short term.
Okay, so growth costs money.
Exactly. And while the report doesn't spell out every single expense increase, it's a common pattern. However, look at their adjusted EBITDA. That's earnings before interest, taxes, depreciation, and amortization. It's a measure that kind of strips out some of those financing and accounting decisions, focuses more on core operations. That figure actually went up significantly by 54.8% to almost CHF 120 million. And the adjusted EBITDA margin improved too, from 15.2% to 16.5%.
Okay, so the adjusted numbers paint a healthier picture of the core business.
Precisely. It suggests the underlying operations are actually getting more profitable, even if the final net income number was down this quarter due to likely those growth investments or other factors.
That makes more sense. Okay, so investments impacting the bottom line for now. Now let's talk geography and products. Where is this growth actually coming from? You mentioned it was widespread.
Oh, yeah. It really was global. But Asia Pacific, just phenomenal growth, up 130.1% in net sales. It's huge. Even constant currency, it's 128.9%.
Wow, over double.
Right. Massive leap. But EME, Europe, Middle East, Africa, also solid, up 33.6%. And the Americas, strong too, up 32.7%. So really broad-based geographic strength. It shows the brand's appeal isn't limited to one region.
And product-wise, it's not just the running shoes anymore, is it? I mean, that's what they're known for, but I saw some eye-popping numbers for apparel and accessories.
You are spot on. Footwear is still the king, no doubt. Brought in CHF 680.9 million, up a very healthy 40.5%. But yeah, look at the growth rates for the other categories. Apparel sales jumped 93.1% to CHF 38.1 million.
Almost doubled.
Yeah, and accessories were even higher, up 99.2% to CHF 7.6 million. Basically doubled as well. This really shows their strategy to be more than just a shoe company, to be a broader sportswear brand. Well, it seems to be working, really gaining traction.
That's fantastic progress on that front. Shows real diversification happening. So, okay, what are the key things driving all this growth? It can't be just one thing.
No,
Yeah.
definitely not. It's a combination. On themselves, point to a few key factors.
Well,
Their multi-channel strategy is clearly working: strong DTC, strong wholesale. They also mentioned successful new product launches, the Cloud Surfer 2, the Cloud 6. Those seem to be hitting the right notes with consumers.
right, the new shoe drops.
And, like we just talked about, that huge growth in apparel is definitely a major contributor now.
And what about the kind of softer side, the brand building, marketing?
Oh, absolutely crucial. You can't ignore the impact of their brand campaigns. They specifically mention high-profile talent, like Zendaya.
Yeah, I saw that campaign. Looked pretty cool.
Right. That sci-fi inspired one, focusing on the cloud tilt lifestyle shoe and apparel, that kind of thing really boosts brand visibility and, desire. Makes it cool. Plus, they talked about focusing on operational excellence, the global store rollout, enhancing that premium customer experience.
So it's the product, the channels, and the image, and the experience.
And innovation, don't forget that.
Yeah.
They mentioned new tech like light spray. That helps maintain their premium cutting-edge image, too.
Okay, so a really well-rounded strategy seems to be paying off. Now, looking forward, what's the outlook? Did they change their forecast for the full year after this strong start?
They did. Based on Q1 and what they're seeing in orders, they've raised their net sales guidance for 2025. They're now expecting at least 28% growth for the year on a constant currency basis, which translates to about CHF 2.86 billion. So a pretty confident outlook.
Okay, 28% growth target. Nice. What about margins?
They also bumped up their gross profit margin expectations slightly to between 60% and 60.5%. Interestingly, though, they kept the adjusted EBITDA margin guidance the same at 16.5% to 17.5%.
So higher sales, slightly better gross margin, but same adjusted operating margin target.
Yeah, could suggest they anticipate continuing to invest heavily or maybe managing those potential headwinds we'll talk about.
Right, because I did see a mention of increased planning uncertainty, something about global trade.
Yeah, that's a really important qualifier they added. They acknowledge that recent shifts in global trade policies are making planning trickier. This could mean things like higher customs duties, more expensive freight, maybe supply chain hiccups, and also the risk of currency swings, especially against the Swiss franc, which is their home currency.
So potential cost pressures and volatility there.
Exactly. It's smart of them to flag it, but they also sounded pretty confident about handling it. They pointed to their premium brand positioning, suggesting they have some pricing power, and said they're constantly looking at their pricing strategy.
Okay, so acknowledging the risks, but believing their brand strength gives them resilience. Makes sense. Now, what about the folks analyzing all this? What are the analysts saying? Markets seem to like the report.
Oh yeah, the market reaction was definitely positive. Stocks to trade, noted the stock, ON, jumped over 11% on the day of the earnings release. That's a pretty clear thumbs up.
11%, wow.
And analysts seem to be largely rallying behind them too. We saw several upgrades on price targets. UBS and Citi, for instance, reportedly pushed their targets up to $59 and $60, keeping their buy ratings.
$5.59 and $60.
Needham also raised their target to $55. So generally a lot of positive sentiment from the analyst community.
That's pretty strong backing. Were there any dissenting voices or notes of caution?
There were a few cautionary points mentioned. Williams Trading, for example, flagged those ongoing worries about tariffs and currency swings as potential risks. So while the overall mood is optimistic, it's not like everyone's ignoring the potential challenges. It's more of a cautious optimism in some corners.
Got it. Balanced view. What about longer-term forecasts beyond just the next quarter or year?
Well, looking out further, Simply Walson's analysis suggests continued strong growth. They're forecasting earnings and revenue to grow around 17.8% and 17.9% per year, respectively, which is still really solid growth. And EPS, earnings per share, growing at about 17.6% annually. They also project a pretty healthy return on equity, reaching 22.5% in about 3 years.
So the growth story is expected to continue, just maybe not at that explosive 40% rate forever.
Exactly. Sustainable, strong growth seems to be the expectation. And TipRanks, using their AI analyst Spark, they rate on as an outperform. They like the strong financials and the strategic plans, but they do add a note of caution about the valuation, the PE ratio.
Ah, the price to earnings ratio. So how expensive the stock is relative to its profits.
Right. A high PE can sometimes mean the market has already priced in a lot of that future growth, making it seem, well, potentially expensive. They also mentioned some technical indicators warranting a bit of caution.
Okay, so analysts are positive on the business, but maybe some debate on the stock's current price.
That seems like a fair summary, yeah. Confidence in the company's trajectory, but awareness of valuation and external risks.
All right, let's switch gears slightly. Let's look under the hood at their financial health. The balance sheet. What does that tell us?
Yeah, Simply Wilson highlighted this on has a really strong balance sheet. Get this. Basically zero debt relative to their equity. A 0% debt to equity ratio. It's incredibly healthy,
Zero debt. Wow.
pretty much. Total assets are around CHF 2.4 billion, liabilities just under CHF 1 billion. They've got a good chunk of cash and short-term investments too, about CHF 968 million. And importantly, their short-term assets, things easily converted to cash, are CHF 1.8 billion. That easily covers both their short-term debts of CHF 660 million and their long-term debts of CHF 324 million.
So they're definitely not stretched financially. Lots of flexibility.
Exactly. They're in a very solid position to fund their growth and handle any bumps in the road.
Now, I think the official report did mention a slight decrease in cash from the end of last year. Is that anything to worry about?
Good catch. Yeah, cash equivalents went from about CHF 924 million down to CHF 872 million between December and March. It's not necessarily alarming, especially given their overall strong position. It could easily reflect them putting money to work, maybe building up inventory to support those booming sales.
Right, needing more shoes and apparel on hand.
Exactly. Or investing in marketing, R&D, things like that. We also saw their net working capital increase during that period. That's basically current assets minus current liabilities. It went up from roughly CHF 499 million to CHF 600 million. That increase could definitely be linked to holding more inventory.
Okay, so maybe just normal fluctuations from investing in growth.
That's the most likely explanation right now. It's something to maybe keep an eye on in future reports just to see the trend, but not a red flag in isolation given how strong the rest of the balance sheet looks.
Okay, great context. So putting this all together now, we've covered a lot of ground. What are the main takeaways, the key things for you, our listener, to remember from this deep dive into ON's Q1?
Okay, big picture. First, just really impressive sales growth across the board, products, regions, shows real brand momentum. Second, the diversification seems to be working. Apparel and accessories are growing even faster than shoes. That's significant.
Right, the head-to-toe brand vision taking shape.
Exactly. Third, that dip in net income. It stands out against the sales surge, so it's something worth watching to understand the drivers better going forward. But fourth, the underlying profitability, measured by adjusted EBITDA, looks quite healthy and is improving. Fifth, analysts are generally bullish, though they do point out potential risks from the global economy and trade issues.
And the valuation question we discussed?
And the valuation, yes. And finally, sixth, their financial foundation is rock solid. That strong balance sheet gives them a lot of stability and resources for future growth. Oh, and we shouldn't forget the impact of strong marketing and partnerships like Zendaya. That seems key too.
Okay, so just to recap the key insights for you. Record sales, broad-based growth fueled by DTC, wholesale, new products, and smart marketing. They've raised their sales outlook, but are also keeping an eye on economic uncertainties. Analysts are mostly positive, backed by a really strong balance sheet. Now here's a final thought for you to chew on. Considering how well Anon is doing, expanding beyond footwear into apparel and accessories, really pushing that blend of performance and design, how might their continued growth reshape the whole premium sportswear market over the next few years? What other kinds of collaborations or product innovations might we see from them as they really try to nail that head-to-toe sportswear brand vision? It definitely makes you think about how brand strategy, financial growth, and market dynamics all play together in this space.